Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. I'm the Chief Investment Strategist at Standard Chartered Bank India. We have just released our quarterly India market outlook titled Positioning for Volatility. In this episode, we discuss our macro and key asset class views. We expect India's economic growth to stay above its long-term trend and ahead of its major peers in the second half of 2023. India's growth is likely to be resilient to weakening global growth given supportive government policies, sustained revival in services, and a pickup in private capex. Further, a likely peak in RBI's policy rate could boost consumption demand. As per Bloomberg estimates, India's GDP is likely to grow at 6.2% and 6.4% for fiscal year 2024 and 2025 respectively. Coming to inflation, in our view, domestic CPI inflation is likely to trend lower in the second half of fiscal year 2024, tracking within the RBI's medium-term target range of 2% and 6%, given high base effect, lagged impact of monetary policy, and a gradual easing of commodity prices. In our view, RBI's decision to keep policy rates unchanged in the past few policy meetings, despite the recent surge in inflation trends, likely signals an end to the tightening cycle. However, we remain mindful of the following key risks to a positive macro outlook. They include a global growth slowdown, persistent high inflation, and escalating geopolitical tensions. Coming to key asset class views, for bonds, we maintain a neutral stance as we expect attractive absolute yields to be counterbalanced by below average yield premiums, stretched medium-term fiscal position, and weak government bond demand-supply balance. We see the recent surge in bond yields as an opportunity to lock in attractive yields with the increased likelihood of a peak in bond yields as the RBI stays on a prolonged pause on policy rates. We are overweight medium and long maturity bonds as we expect the 10-year Indian government bond yield to trade in the range of 6.75 to 7% over the next 12 months. We have a preference for corporate bonds or bonds that offer a yield premium over government bonds. In our assessment, corporate bonds offer a better risk reward given attractive credit spreads and improving corporate fundamentals. In addition, higher absolute bond yields and lower currency volatility provide a stable carry relative to other emerging market peers. However, three factors remain unfavorable for bonds. First, fiscal deficit is likely to remain high over the medium term. Second, worsening government bond supply balance given high supply of government bonds amid a lack of support from the RBI. And third, higher than expected inflation could keep bond yields elevated as the RBI maintains a prolonged pause on policy rates. Coming to equities, we remain neutral as robust domestic growth and strong corporate earnings cycle is counterbalanced by stretched valuation premiums, both absolute and relative to peers. Within equities, we have downgraded mid-cap and small-cap equities to neutral given stretched valuation premiums over large caps and downward earnings revision over the past 3 months. We prefer value-style equities. In our view, Indian equities are supported by the following drivers over the medium term. First, economic growth and earnings outlook remains robust and continues to outpace its major peers. Indian equities underperformance in Q1 of 2023 amid strong earnings delivery has turned valuations more reasonable. Third, stable inflows from domestic investors driven by inflows into systematic investment plans is a key support for the market. And fourth, positive foreign investor inflows amid reasonable valuation, robust fundamentals, and low foreign investor positioning in Indian equities. However, risks to our positive equity views are 1. Global growth slowdown and probable downgrades of earnings expectations. Second, above average equity valuations, both absolute and relative to peers. And third, foreign investor selling amid slowing domestic investor flows. Coming to sectors, we prefer a barbell sector strategy. We are overweight domestic cyclicals given resilient domestic growth, favorable earnings expectations, and relatively better valuations. Balance this overweight in domestic cyclicals with an overweight in healthcare given its defensive nature and improving earnings outlook. Our key sector overweights include financials. Broadening economic growth recovery is likely to drive an improvement in retail credit demand, and healthier corporate balance sheet, robust loan disbursement momentum is likely to offset margin compression due to rising funding costs. Earnings expectations for the sector remains strong. consensus expectations of an EPS growth of 16% and 20% in fiscal year 2024 and 2025, the sector trades at a valuation discount to its own 10-year average and overall market valuation. Industrial is another key sector overweight for us. The sector benefits from a multi-year investment-led economic growth cycle with earnings growth for fiscal year 2024 and 2025 at 44% and 25% respectively, which remains higher than most sectors. The government's continued focus on capex, coupled with providing incentives to boost manufacturing and infrastructure spending, is a strong structural driver for the sector. Healthcare is the third sector overweight. We prefer the sector for its defensive nature, acting as a potential hedge against an uncertain global backdrop, and are overweight on domestic cyclicals. The sector has recovered strongly in 2023 after underperforming in 2022 on COVID-era expensive valuation multiples and muted earnings performance on a high base. The earnings outlook for the sector has stabilized. The sector trades at a lower valuation premium, with current 12-month forward PE at 31.7x compared to 2020 peak of 36x and 24x long-term average. Cash continues to remain a neutral holding, while gold continues to be a neutral holding, a key portfolio diversifier in times of uncertainty. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of our India Market Outlook. And thank you as always for listening. If you enjoyed the podcast, please like and subscribe.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.